Welcome, everyone. Jay, quickly, so what do you make of the ISM report this morning? It was a little better.
Yeah, it was a little better, Kelly. It was good to see that, it didn't decline anymore, but we still are, at least in terms of the headline, still in negative territory there. So, maybe at best the manufacturing sector right now is roughly flat.
What is your larger concern about the economy?
So I think the larger concern, Kelly, is we're going to continue to see, I'll call it a passive tightening of monetary policy as we go forward. I mean, our guess is the Fed is probably done. Maybe they go one more rate hike. I mean, who knows, right? But I think what's more important is we'll probably continue to see the inflation rate come down. And so what happens is the real interest rate will just passively continue to rise here, and that exerts real headwinds on real economic growth. And so I'm just concerned that the economy is operating a little bit above potential right now. The Fed has to keep a tight policy stance to bring inflation down, and you're going to get this passive tightening of policy as we continue to go forward.
And you'd think Rick Santelli, with all of this happening from the old playbook, anytime you feel there might be a softening in the outlook, what happens? Long-term bond yields decline. Well, the complete opposite of that is happening right now. So do you think that bonds are looking to the ISM data and taking a lift on that, or is something else driving them higher here?
I think something else is driving them higher. I think if we take a step back and just acknowledge the fact that the Fed kept rates much too low for much too long. And I think when you have a decade of basically zero interest rates, the normalization is going to be bumpy. And I think what's more, when the labor market seems to be the new conundrum, and you have to make many assumptions to try to explain some of the strength in the labor market that's so counterintuitive, but I keep coming to the same conclusion. I think econometric models and seasonalities are ultimately going to be under review. And the problem with that is that should this become a binary issue, meaning that one day it looks great and then all of a sudden it doesn't, that's going to really be an issue for the Fed. And in terms
here's what I would not to interrupt, but I almost wonder, Rick, if the only way out. So rising yield, this whole situation is so interesting because we just had shutdown talks and a shutdown that didn't happen over spending cuts that were not even going to happen. And we wake up today and we see long end yields moving higher as a result. So the only thing that I see arresting that increase is if the economy really slows. I mean, would that bail us out here? Because at least finally there would be some buyer of treasuries. Right now, there aren't enough buyers, it seems, for all the supply out there driven by all of these government deficits.
Yes, whether it's $2 trillion in T-bills or the fact that the government just keeps on spending. And you know what? Let's make it even easier. I really do think a good chunk of what's going on today in 7s, 10s, 20s, 30s, boons, almost at 3%, is all the same. If you want to keep borrowing like drunken sailors and spending, at some point the market's going to extract the cost. And we are now seeing that in live view.
Right, but it's not, I don't think anyone in Washington even, do you think they realize what's happening?
I don't think anybody in Washington realizes the difference between daylight and dark time. I honestly just don't see that there's any change. And when you consider one of the issues why labor might appear to be so strong, it's almost like the third rail. What do my sources tell me? That the government was too generous. Programs have outlived COVID are too generous. That you've taken out a segment that should be working that can get along just fine without working. So maybe self-inflicted. We need to talk about these things more.
Well, one way, so Steve, the interesting thing about this as well is that this isn't an area the Fed ever wants to wade into, right? They never want to get involved with talking about government spending choices and the deficit and the debt. But are these hints about financial stability alluding to the fact that they realize that the long end is starting to behave a bit unhinged?
I think that's an interesting comment, Kelly, and it was sort of going in the back of my mind. Why is Michael Barr talking about this issue of the impact of rates on financial stability right now? And I think there may be something to that you have to go carefully here and wade carefully. And I find myself agreeing more with Rick than disagreeing with him, which is an unusual place for me to be.
He's holding his heart.
In that, I'm dramatically disappointed in the Yellen Treasury on two reasons. One is that when she was in the Federal Reserve, when she was at the Federal Reserve, she talked long and hard about the unsustainability of the debt. Here she was in a position to do something about it, and from what we could tell, did not necessarily argue forcefully or was not an important force in the arguing against the issue of putting the U.S. on a path of unsustainable, even more unsustainable debt. It was on that path before Biden took office. It was continued under Biden and the Yellen Treasury.